My cousin Mateo got his first real paycheck at 22. Not his first paycheck ever, his first real one. The kind where you look at the number and suddenly start seeing yourself differently. For about 12 minutes, Mateo was basically a Wall Street billionaire. Then reality kicked in. Rent, groceries, a couple of dinners he absolutely did not need. And somehow, 6 months later, he still hadn't invested a single dollar. Not because he was irresponsible, he actually wanted to. He downloaded an app, opened it once, saw words like index funds, expense ratios, capital gains, diversification, and closed it immediately. It reminded him of opening a tax document written by someone who clearly wanted him to suffer. And honestly, I understood. Investing has a weird way of making intelligent adults feel like they've walked into a conversation halfway through. Everyone else seems to know what they're talking about. You don't, so you wait. Next month becomes next year, and suddenly you're 35, still Googling, what exactly is an ETF? So let's do this differently. No vocabulary contest, no complicated charts, no pretending you need a finance degree before you're allowed to invest. Let's start at zero. Why saving alone isn't enough. The first thing Mateo had to understand is that saving and investing do two very different jobs. Your savings account keeps money available and reasonably safe. Your investments give that money a chance to grow. That matters because prices don't sit still. Inflation means the same $100 generally buys a little less next year than today. So if your money earns less interest than inflation, your balance looks perfectly healthy while your purchasing power quietly shrinks. Nobody sends you a notification saying, "Congratulations, your money is now worth slightly less." It just happens. Then there's opportunity cost. Money sitting in cash isn't out there growing somewhere else. Historically, broad U.S. stocks have returned far more on average over long periods than cash and savings. But stocks don't hand you that return smoothly. Some years are great, some are awful, some make you wonder why you ever thought investing was a good idea. That's the trade-off, short-term uncertainty for long-term growth. And no, investing isn't gambling, despite what your uncle insists at Thanksgiving. Gambling has the odds stacked against you on purpose. Investing in a broad slice of the economy is a bet that companies keep doing what companies do, mostly making stuff people buy. What you're actually buying. Imagine Mateo somehow has $10,000, which, to be clear, nobody has ever handed him. Option 1. Put it all into one company, say Apple. Great year for Apple, great year for Mateo. Bad year, and his entire investment rides on that one company's mood swings. That's concentration risk, not exactly the beginner-friendly move. Option 2. Buy a fund that owns hundreds of companies at once. A sliver of Apple, a sliver of Microsoft, a sliver of Costco. One company has a terrible year, it barely dents things. That's diversification, and for a beginner, it's one of your best friends. Here's the part that simplifies things instead of complicating them. An ETF is a fund that trades on an exchange, like a stock. An index is just a predefined list, say the 500 biggest US companies. An index fund tracks that list instead of a person picking stocks. Think of the index as the shopping list, the fund as the basket, ETF as the label for how that basket gets bought and sold. Instead of guessing the next Apple, a broad index fund gets you a slice of hundreds of companies in one purchase. Mutual funds work similarly, except a person is actively picking stocks, trying to beat that plain list, usually charging you more for their opinion. And bonds are the boring, reliable friend of the group. You're lending money to a government or corporation for steady interest, lower reward, way less drama. Stocks, ETFs, index funds, bonds, everything else, real estate funds, dividend funds, is just a remix of these four songs. Where does the money actually go? Mateo's next question was the sensible one. Fine, but where do I actually put it? There are really two questions hiding in one here. What are you investing in, and what account are you investing through? Think of the account as the container. First, check if your employer offers a 401k match. That's free money, part of your compensation. Skipping it is basically telling your employer, "Thanks for the extra money, I'll pass." Second, a Roth IRA, where you contribute money you've already paid tax on, and qualified withdrawals in retirement come out completely tax-free, especially attractive when you're young. Third, increase your 401k contributions beyond the match if you can. Fourth, a regular brokerage account, flexible but no special tax treatment, which is exactly why it comes last. An HSA and a 529 plan exist too, both genuinely useful, both a later problem. You don't need 5 accounts open by Tuesday. Where should you open the account? This part is much less exciting, which is good. Fidelity, Vanguard, Charles Schwab, all established, all reputable, all with their own strengths. But please don't spend 3 weeks comparing apps because one has a slightly nicer shade of blue. The perfect brokerage isn't going to make you wealthy. What matters is a low-cost, reputable place where you can invest consistently. Pick one, move on. Your future self has other things to do. But what if the brokerage goes bankrupt? A reasonable worry. Brokerage accounts carry protections for exactly this, the failure of the brokerage itself. That's not protection against market losses, though. If the market drops 20%, nobody from the government calls to say, "Don't worry, we fixed your portfolio." Your investments can lose value. That's just part of investing. The protection covers the firm disappearing, not the market having a bad day. And your shares are legally yours regardless. If the brokerage vanished tomorrow, your holdings would simply move house, not disappear. So what should a beginner actually buy? Here's where I want things to get boring. Very boring. A broad, low-cost index fund is a genuinely respectable first purchase, something tracking a broad U.S. stock index, or one covering the entire U.S. market. Add international exposure later, and bonds if you want fewer stomach drops. You do not need 12 funds, cryptocurrency, or the coin your cousin's coworker swears is about to explode. Simple is allowed. Simple is often the whole point. But what if the market crashes? This is the question underneath almost every beginner question. It could crash. Markets do that. But if you're investing for decades, what happens next Tuesday matters far less than what you do over the next 20 or 30 years. The real danger isn't the market falling, it's you panicking when it does. Your portfolio drops 15%, your brain starts drafting emergency evacuation plans, you sell, and the market eventually recovers without you. That's how a temporary dip becomes a permanent loss. You're the one who made it permanent. How much should you invest? Mateo thought he needed a perfect number. He didn't. The best starting amount is whatever you can invest consistently without wrecking your budget. $50 a month, $200, more. The number matters less than the habit. As income grows, so can the contribution. Set up a transfer around payday and stop renegotiating with yourself every month. Because if investing needs a fresh motivational speech every payday, eventually you're going to lose that argument. What actually happens when you buy? This part is almost funny. Mateo spent months worrying about investing, and when he finally did it, the whole process took about 2 minutes. Money goes into the account, you choose the investment, enter the amount, place the order. That's it. No bell rings. Nobody on Wall Street notices. You just own a tiny piece of a collection of businesses, possibly the least cinematic financial transformation imaginable. And that's fine. A quick word about taxes. If you invest through a taxable brokerage account, selling for more than you paid can create a capital gain, taxed differently depending on how long you held it. That's one reason tax-advantaged accounts are so useful. But don't let taxes become another excuse to never start. You don't need the entire tax code memorized before buying your first diversified fund. The mistakes that actually hurt beginners. Most beginners don't lose money because they picked an ETF with the wrong 3-letter name. They lose money making emotional decisions, waiting for the perfect moment, checking the portfolio every morning like it's a group chat that might finally reply, selling because the market had one bad month, jumping funds because something else did better last year. And maybe the biggest mistake of all, just waiting. 5 years from now, Mateo could have a 5-year-old investment account, or he could still be researching which brokerage app has the nicer shade of blue. Mateo's first portfolio. A couple of years later, Mateo's strategy was almost offensively boring. Money went in automatically. He owned broad, diversified investments. He didn't check his balance every morning, didn't try to guess the market's next move, and didn't suddenly become a financial genius. He just stopped interfering. That might be the most important investing lesson there is. You don't need to beat everyone, find the next huge stock, or predict the next crash. And you definitely don't need to make investing exciting. You need a reasonable strategy, some diversification, patience, and enough time for compounding to quietly, repeatedly do its job without asking for applause. Building wealth is usually far less dramatic than people expect. It's not a Lamborghini, not a trading floor, not one genius stock pick that makes you rich overnight. Sometimes it's just an automatic transfer on payday, followed by you getting on with your life. And honestly, that's probably the best part, because the goal was never to spend your life thinking about money. It's to build a system that works quietly in the background while you get on with yours.